Hello, my name is Julia and this is Fix My Finance. When shopping around for credit, you have probably noticed that you're often shown the representative APR of a loan or credit card before applying. But have you ever wondered why you can't just be told what specific APR you will be offered if you apply? Today's video is all about APRs, the truth behind these teaser rates, and how you can find out the rate you will get before applying. So, let's fix some finances. If you're thinking of applying for credit or have applied for credit in the past, the APR or interest rate is probably one of the main things you look at, given that it is essentially the price you pay for your loan. So it makes sense to look at the product with the lowest APR possible. But what makes up the APR in its entirety? APR stands for annual percentage rate. It consists of the interest rate you have to pay each year and any charges you may incur from your lender. This will also include any arrangement fees due at the start of your loan. Put simply, the APR is the overall cost of your loan. For example, say you borrow £2,000 at 10% APR over 5 years. If during the first year you don't pay anything back, at the end of the first year you would owe your lender £2,200, the £2,000 you borrowed and £200 in interest. Of course, most lenders require regular monthly payments. This means you'll pay slightly less than £200. But why is the advertised APR usually called representative? And how is this different from guaranteed or real APRs? The Financial Conduct Authority, the financial regulator in the UK, requires all lenders to display an APR on all financial product offerings to allow customers to compare products on a like-for-like basis. However, the actual rate you will get as a customer will depend on your individual circumstances, and without any information about your credit report, it will be very hard for lenders to work out an accurate rate for you upfront. Therefore, lenders don't tend to display your guaranteed APR, but instead use an average rate, the representative APR. To make sure that the advertised rates are indeed the average rate that a typical customer will get, lenders can only advertise an APR as representative if at least 51% of customers will get this rate or cheaper. On the flip side, it is likely that up to 49% of customers will get a higher rate than the representative APR. Research from Schulberg Bank found that the gap between the APRs lenders are advertising and the APRs people are actually getting is expanding. Many households pay more in loan servicing costs than they initially expected, which costs UK consumers an estimated £204 million a year. Yes, you heard that correctly. These higher APR costs consumers £204 million every single year. This difference between advertised APRs and actual APRs can be clearly seen in this chart by the Bank of England. As you can see, the average APR actually paid by a borrower for a fixed-rate personal loan is currently 7.3%. Whereas the representative rates advertised by leading UK lenders range from 2.8 to 4.9%. What's worse is that 83% of people expect to be offered the representative APR when making their application, but we know that in reality, only 51% of people will likely get this rate. Clearly, there is a lot of confusion around the difference between representative and guaranteed APRs. While representative rates are headline rates that represent the average rate received by customers, a guaranteed or real APR is the interest rate you will actually have to pay if you get the credit card or loan in question. This is calculated by the lender based on how risky you are as a borrower and is based on your personal credit history. The better your credit score and credit history looks, the more likely you will be accepted for lower APRs. Let's say you're looking to take out a £5,000 loan over 36 months. ClearScore data has shown that users with a credit score of less than 250 were, on average, offered a representative APR of 49%. But the APR they actually received from lenders following an application was 63%. This meant they would end up repaying an extra £1,554 on top of their loan. In contrast, for the same loan and term, users with a score between 550 and 700 were offered a representative APR of 12%. On average, the APR they ended up with was 14%. They would then have to repay an extra £192 on top of the £5,000 loan. These examples show that your credit score affects the APR you will get, and that the difference between the advertised and real APR could end up costing you a small fortune. So how can you figure out your real APR before applying? Normally, this is a little bit of a chicken and egg situation, as you don't know the real APR until after you've made a full credit application. However, increasingly lenders have started to use soft searches to show your guaranteed APR and your eligibility for a particular product before you apply. Marketplaces like ClearScore will enable you to see your guaranteed APRs and eligibilities from various lenders upfront, without hurting your credit score. If you want to understand how this works and what soft searches are, feel free to check out our previous video on this topic. It is important to note that whilst guaranteed APR products may often seem more expensive upfront compared to lower rep rate products, it is highly likely that you will get a higher rate when you actually apply for a rep rate product. This is why I personally recommend choosing guaranteed rates and pre-approved offers, as what you see is what you get. So there we have it. I hope this video was helpful in giving you an understanding of APRs, what representative versus guaranteed rates are, and why I personally choose guaranteed rate products, even if they may appear slightly more expensive upfront. If you learned something new today, please give the video a like, share and subscribe for more content. If you've ever applied for a financial product and ended up receiving a much higher APR than the representative rate, let me know in the comment section down below. And I'll see you here next time, when it's time to fix some finances.